the Shanghai Gold Exchange and the Shanghai Futures Exchange sees the physical price of silver go higher, and at as much as $3 and $4 higher than the West, and because of this arbitrage that's sucking all the metal over there, right? And these traders don't have loyalty to this country in terms of the long-term ramifications. They're making a ton of money. So as this demand keeps flowing there and the price goes higher, you got the brain dead bullion banks and the COMEX and the LBMA that continue to slam down the price harder.
Yeah, the banks are short hundreds of millions of ounces, and they're feeling the pain today. And I know that for a fact. So we have to take advantage of the current metal prices, which we do and are doing right now. But it's interesting because the bank limits that a lot of these traders have hit their limits. On the supply side, we haven't seen any new supply, and I don't see any new supply. I see less supply.
And the spread between silver in the West and silver in China is at least 10 to 15% as a result of all of this, or higher.
Inflation is a hidden tax, basically. They're lying to us about our tax rate because they're stealing from us in a way that doesn't show up in the official marginal tax rate. That allowed the government to lie by omission, basically.
In today's weekly recap, three precious metals experts, Keith Neumeyer, John Rubino, and Andy Schectman, share their insights on the current situation for the gold and silver markets. They talk about the recent silver price volatility and how the recent news affect the supply and demand for gold and silver. We watched hours of their latest interviews to get the best clips, so you don't have to. Now we'll show you the best clips, but first, smash the subscribe button, hit the like button, and turn on notifications so you do not miss out our recaps. Enjoy the episode.
So if you look at Coeur d'Alene's or Coeur Mining's production numbers, you look at First Majestic's silver production numbers, Pan American silver production numbers, silver production is dropping worldwide. And there's all kinds of reasons for it. We can have maybe when I see you in Florida, we can have a beer together and I can explain all the different nuances that go on in the mining sector. But permitting is the biggest issue. And that is getting more and more difficult. Countries around the world are more reluctant to permit mines. We're trying to get silver on the strategic metals list. I remember watching an interview from Pierre Lassonde about I guess it was about 2 years ago, and he said on this interview that he was called up by the mining minister of the province of Ontario here in Canada, and the minister asked him, how do we produce more metal? And Pierre Lassonde was blown away. He said, "What do you mean? How do we produce more metal? You give us permits so we could produce more metal." And this minister of mining had no clue. Right. So if Mexico wants to loosen up their permitting, or Nevada or Arizona, or Canada, where most of these metals come from, we could produce more metals as an industry. But for the mining sector, and I'm the chairman of a company called First Mining Gold, which many of your listeners probably are familiar with. We've been working for 7 years on a permit. The asset was discovered in 2010. It's now 2024, 14 years after discovery, and still hasn't got a permit. We're not expecting a permit for probably the next 2 to 3 years. And that's if everything goes smoothly. So the burn rate on that permit is about $20 million a year. So over that 20-year period, it costs around $300 to $400 million just to get the permit. Then you have to break ground and build the mill, which is going to be another $600, $700, $800 million. So how long is it going to take you to get payback on that? So institutional investors, they don't have the patience. So you go to an institution, say, I want $50 million, I'll pay you back in 20 years. They're going to laugh at you. So it's a very difficult industry, very tough to raise money for, and it's a long game. And you have to have patience as an investor, but you have to have patience as a management team. And at First Majestic, I think we've proven ourselves, over the last 20 years. But it is a big challenge, talking about silver, talk to the governments and ask them the question, why don't they put silver on the strategic metals list? If they did, then maybe governments would wake up and say, hey, look, we need this metal and we're going to fast track permitting. And rather than taking 20 years to get a permit, we'll do it in 3 years. And if they did that, then we could potentially get silver ounces produced, or more silver ounces produced on an annual basis.
In the continuation of the episode, Andy Schectman talks about the current premiums in gold and silver and the current war east versus west for the metals.
In the last few weeks, I've talked with you 2 weeks ago about how you're seeing these exchange for physical deliveries that are these large deliveries of kilo gold bars in particular that are being purchased in the West, delivered to Brinks, Hong Kong, which is a COMEX facility, and then being trucked over to the Shanghai Gold Exchange. We've talked a lot about how the vaults are being drained and the bankers showing up at the Shanghai Metals Exchange, and now those vaults are being drained, in particular in silver, because you can't export gold, and these things are undeniable. But I just want people to understand kind of simplistically what's happening. So the Chinese vaults are being drained due to the large demand exceeding supply in West. And I think these bullion banks are trapped. I know Alistair McLeod kind of alluded to that in your interview with him that I watched last night, that these banks are trapped. And so the Shanghai Gold Exchange and the Shanghai Futures Exchange sees the physical price of silver go higher, and at as much as $3 and $4 higher than the West. And because of this arbitrage that's sucking all the metal over there, right? And these traders don't have loyalty to this country in terms of the long-term ramifications. They're making a ton of money. So as this demand keeps flowing there and the price goes higher, you got the brain dead bullion banks and the COMEX and the LBMA that continue to slam down the price harder. And the spread between silver in the West and silver in China is at least 10 to 15% as a result of all of this, or higher. And so these Western vaults are being drained as the traders are monetizing the arbitrage. And so when you see silver in the vaults drop to their lowest since 2020 in Shanghai, that is a very ominous sign, because once those vaults are drained, we already know there's only roughly 300 million ounces of silver on the LBMA, if we believe what they're saying.
In today's market recap, Wall Street throws in the towel on gold after Friday's rout. Main Street optimism likely a pre-sell-off snapshot. This week, precious metals markets saved all their drama for the grand finale. Spot gold opened the week trading at and spent much of the first 4 days trading in a relatively narrow $25 range. The expected 25 basis point rate cuts from the ECB and the Bank of Canada came and went, with spot gold eventually setting its weekly high just after midnight on Friday. North American traders went to bed Thursday night expecting Friday morning's non-farm payrolls, NFP, report to be the week's highlight for gold. But the People's Bank of China, PBOC, stole the spotlight in the early hours, announcing at 4 a.m. EDT that they had broken their 18-month streak of sovereign gold purchases in May and sending metals prices crashing through multiple levels of support as algorithmic stop-loss orders were filled in rapid succession. Spot gold sank like a stone, with much of the move taking place in a matter of minutes. Then the yellow metal was in the moments before the 8:30 a.m. release of the surprisingly strong U.S. jobs report, which drove gold down even further as markets recognized that the Fed would have even less reason to cut in the near term. As gold was already down over $40 at that point, the NFP took the yellow metal all the way down to support. Now we'll show you the best clips, but first smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Converting their currency into real stuff. And, silver, which you mentioned, is a great part of that story, because it has basically two things going for it. One is that industrial applications are growing for silver, and the demand for silver in solar panels and satellites and electric cars, and it goes on, is rising at an accelerating rate. And right now, silver is in deficit, meaning that the world's silver mines aren't producing enough silver to cover what industrial users and investors are demanding right now. So we're running through the above ground stocks of silver. And when that runs out, then you go from deficit to shortage, which usually means prices have to go up to increase the supply somehow. And an analyst just came out lately with a time frame for that, and he said 1.5 to 2 years before we run out of above ground silver, and the price mechanism has to really kick in order to allocate what there is out there. And India, for instance, is a good example of the response to that, because they just imported more silver in the first quarter of this year than in all of 2023. And they're normally a big importer of silver, so that we're talking serious numbers in that case. And they, at the same time, repatriated 100 tons of gold from London back to India. So take what India is doing and kind of spread it out around the world, and you've got different entities, whether they're countries or companies or individuals, doing variations of that. They're buying silver coins, or they're stockpiling gold because they see a currency crisis coming, or they're buying every bit of copper they can get their hands on, because if we're going to electrify the world, it's going to take 3 times as much copper as comes out of today's copper mines. And then what are we going to do then? And so everybody has their reasons, but it all involves a thought process in which they conclude that the currency that they have is worth less than the commodities they could buy with that currency. And, you reach a point where it dawns on everybody that we're literally running out of this stuff, which is another way of saying we've got tons of currency relative to the amount of commodities that there are out there. And we really need to convert all the currency that we have into these commodities, if it's at all possible. And so that, within the framework of the crack-up boom, that means the price of real things goes through the roof, but not because there's a huge increase in the supply of currency. It's not inflation as we typically envision it. It's a loss of faith in the amount of currency, or the currency that exists now. And so nobody just wants to hold those currencies anymore. So that's a conceptual difference that works out the same thing, which is that the price of real stuff goes through the roof. And the market value of financial things like government bonds and bank stocks and, Goldman Sachs equities and things like that tank. And you get a revaluation in both directions, where commodities relative to the size of the global economy, they go up, while financial assets relative to the size of the economy go way back down. There's a cycle in the gold market where the S&P 500 and gold's market cap fluctuate against each other, and sometimes they're trading at 1-to-1, and other times they're trading at this massive premium of the S&P 500 over gold. And lately, we've been in a situation where the S&P 500 was vastly more valuable than the market cap of gold, but we're heading back in the other direction now. And if we go back the way previous cycles have gone to 1-to-1, then that takes the price of gold to $15,000 or $20,000 an ounce. So that's one metric that you can look at that's fundamental, that gives you a reasonable way of estimating the value of gold. And it could easily do that, because it's done that a couple of times in modern history already. So it's not unprecedented. It's just something that happens when the cycle swings all the way to the other side. And it wouldn't be a surprise at all to see that happen again this time, because all the other numbers are so far out of whack that we should expect the pendulum to be swinging really wildly for the next decade or two.
What do you think of today's show? Which one of the 3 experts will be correct? Post in the comment section your honest opinion for the supply-demand situation for silver, and share your gold price prediction for the end of 2024. Now watch this video right here, because it's a perfect fit for you. I see you on the other side.